The thing is that the Fed has made a pivot from rate hikes to rate cuts, and that's going to be construed as bullish, even though inflation is coming down. When you add the other factors that are currently affecting gold, specifically geopolitical tension in Ukraine and Russia and the Middle East, that has the ability to offset inflation coming down, because now it's not so much an inflationary tool, but rather a tool against a safe haven play. And that's what I think, if you add that into the mix, that's what takes gold higher, is a combination of both of those variables.
2024 will be a momentous year for monetary policy because the Federal Reserve has finally signaled that it will pivot. What do lower interest rates mean for the equity markets and gold? We're here to find out with Gary Wagner, editor of thegoldforecast.com. But first, a message from our sponsor, iTrust Capital, an IRA that offers more than 30 crypto assets and the lowest trading fees in the crypto IRA space, as well as tax advantages. If you're over 18 and you want to open a new account with cash or roll over an existing account, click on itrust.capital/David in the links down below to get started. Welcome, Gary, to the show. Very honored to be hosting you as one of my first guests for 2024. So welcome back. Happy New Year to you.
Thank you so much. And I'm really honored to be your first guest, or close to your first guest, and to talk to you in 2024. Happy New Year.
Happy New Year to you too, and to your family. Let's talk first about your overall outlook for monetary policy and how it affects gold. But first, you have a fun thing to share with us. You actually asked ChatGPT what it thinks gold would do for 2024 and beyond. And your prompt was forecast gold in dollars for 2023, 2024, 2025. Well, I guess 2023 doesn't apply, but 24 and 25 critical topics, which will define gold's price structure over the next 3 years, potential reshaping of currency dynamics listed below. And then you have a number of factors that you inputted, including geopolitics, conflicts between Russia and Ukraine, possibility of a dollar decentralization, and of course, the influence of Fed monetary policies. And so this is the output that ChatGPT gave according to your prompt. 2024 easing measures unveiled. In 2024, the Federal Reserve is projected to implement a series of rate cuts ranging from 0.75% to 1%. The easing is expected to bring the Fed funds rate to 4.6, diminishing the opportunity cost for holding gold and potentially stimulating demand. Estimated gold price in 2024, $2,400 to $2,500. 2025 sustained accommodation. Moving into 2025, interest rates are anticipated to remain between 3.5% and 4%. Sustained accommodative policies could bolster gold's appeal as a safe haven asset. Estimated gold price in 2025, $2,600 to $2,700. So far above new all-time highs for both 2024 and 2025. Do you agree?
Well, the numbers that I did were created in a much different way. I used a technical strategy that I've been using for 10 to 15 years, which is Elliott wave count, to kind of define where we are in the trend. And then what I look at is a recent rally, and then I take it to the end of the correction, and then I do a Fibonacci extension. It was based on an extension of a third wave. So on a third wave, you will typically look at 6.18 to 0.78% of an extension. And so I used that extension, and I came up with about 2180. If I went further to a 1.23 extension, I came up a little bit higher, and that took us to 2250. So I'm a little bit more conservative than what the AI platform was saying, but it was still somewhat in line, especially in the outer years.
Well, let's highlight the first assumption, which is that the Fed will ease monetary policy this year. Certainly that is the expectation. Gary, do you see any potential risks that could derail the Fed's projected rate cuts?
Potential, absolutely. These numbers are based upon the fact that they are clearly on their current trajectory, which is to a 2% target in inflation, and that they have tightened enough, they have raised interest rates enough, they've kept them elevated for long enough that as long as the trajectory to 2%, because that is their absolute goal, continues, they'll operate under very, very closely to the numbers they put out in December, which is the SEP, the Summary of Economic Projections, and the dot plot itself. However, if inflation shoots up, if other variables come into play, they will have to adjust their targets and projections to reflect new data.
How many rate cuts do you anticipate will happen, Gary? I believe at the last press conference, Jerome Powell signaled three. The dot plots, I think, signal around three. The markets, the bond markets in particular, are signaling more than that. The equity markets, some told me, have priced in more than even four. So, what is your expectation?
Well, I think that the Federal Reserve is being conservative with this output. I personally believe we could see four, but I am expecting to see the three. That's what they announced. I think if they see that inflation is coming down faster than anticipated, it would warrant a further rate cut from their projections as it stands.
Here's what I'm wondering in relationship to gold. Interest rates coming down historically, that's been positive for gold. If the real rate is going down, that's positive for gold. However, like you mentioned, inflation is also coming down. Gold, as seen as perceived as an inflation hedge, should do well when inflation goes up, not down. So how do these forces balance out?
Well, they do balance out. The thing is that the Fed has made a pivot from rate hikes to rate cuts, and that's going to be construed as bullish, even though inflation is coming down. When you add the other factors that are currently affecting gold, specifically geopolitical tension in Ukraine and Russia and the Middle East, that has the ability to offset inflation coming down, because now it's not so much an inflationary tool, but rather a tool against a safe haven play. And that's what I think, if you add that into the mix, that's what takes gold higher, is a combination of both of those variables.
Just on the geopolitical risks, you highlighted the war in Ukraine as well as ongoing tensions in the Middle East. Well, the war in Ukraine has been going on for quite some time now, as you know, and the Middle East war in Israel broke out in October, which has
Right.
been 2.5 months so far, or almost 2.5 months. Are you suggesting or assuming that these conflicts will escalate? Because if not, why would gold move?
Excellent question. First of all, in regards to Ukraine and Russia, correct. It's been going on for quite some time. But in the last 2 weeks, we have seen Russia escalate that to where they're sending in huge amounts of missiles and salvos that they have never done before during the first 2 years. Might have to do with the fact that there's an election coming up with Putin and he wants to show that they're winning the war. But the crisis in Russia-Ukraine has absolutely escalated. It has ratcheted up to a new degree of warfare. In terms of the Middle East conflict, you've got a continued problem. Israel came out and said this month will take months, not days, and that was announced a few days ago. And to add to that, you have these factions of Iran, whether it's Hezbollah, whether it's the ones in Syria, Iraq, or Yemen, all attacking either US targets and military bases or attacking Israel itself. And so that really complicates it. I really personally believe that Iran, through their proxy entities, wants to get an involvement that brings in more countries, and they want to control the dialogue by, they just launched one of their big ships into either the Mediterranean or the Red Sea, I'm not sure, but right where there's a large aircraft carrier group, which you couldn't avoid anyways, because I believe we have all five of our carrier groups within that region right now. So it doesn't seem, to me at least, as though these conflicts are coming to a conclusion, that there is talk of peace on any front. And if anything, there's still very, very much a full-blown war in both regions.
Historically, how has gold performed when tensions arose or hot spots came out of nowhere? In other words, when wars escalate or pop out from the left field, what does gold usually do? Maybe you can bring up some historical examples.
Well, historically, we haven't seen so much extended wars, not in the last long time, but what we have seen is what I call saber rattling. So when North Korea threatens to do a nuclear test, you might see gold run up quickly, but also come down very quickly. Buy the rumor, sell the fact, so to speak. We've seen that in any of the conflicts in the Middle East, whether it's Iraq with another country or any of the regional conflicts, it tends to take gold higher very quickly, but also correct with that same kind of speed. In other words, it comes back down because it doesn't evolve into a full-blown war. What we're witnessing now is different because, as you said, Ukraine and Russia have been going at it for 2 years. That is not just a skirmish that's going to end quickly, nor has ended quickly. Both have vowed adamantly. Ukraine vows to protect Ukraine as a sovereign land. Russia vows to take Ukraine over. And there seems to be very little room for compromise on that front or to reaching some sort of a peace agreement without one side or the other completely doing a 180 on their position. And that is what I believe is genuinely different now than what we've seen in the past.
Okay. Well, let's just take these two examples and see exactly what gold has done. In February 2022, when Russian forces crossed the Ukrainian border, gold, as you remember, was already going up because the real interest rate was going down. But in late February, it spiked from on February 24th, gold was trading at 1908, and then it spiked to $2,000 and 65 20 yeah, above almost $2,100
Mm-hmm.
at its peak. As you recall, it didn't stay there. So we're looking at a premium of roughly $150 before it went down in days afterward. Similarly, in October, when the Gaza-Israel war broke out, the gold price did shoot up and fell shortly after. What I'm saying is the geopolitical risk premium we've seen in these two particular conflicts have not maintained their elevated levels before we saw a pullback. So are you expecting a certain level to be broken, and then maybe a strategy would be to take profits after this?
Well, that's obviously a one possible scenario. The difference is when you mention what I call the October rally, which is in conjunction with the conflict in the Middle East, it does run to an absolute high that we haven't seen. It comes down very quickly, but about the beginning of December, I think it was at around 1960 in terms of price point, it kind of finds support and then moves back up and then runs back, well above 2000 and then challenged 2100. As of this recording, we're sitting back at around 2080. So we have come off of those lows of 1960. The other thing that I believe is a really solid point to bring out about gold's performance, if we look at where gold opened January 1 of last year and where it closed December 31st of last year, 2023, there was a net gain of about $170. Through there were big peaks, valleys, definitely. But when you look at where it opened and closed during that 1 year period, there was a net gain that was pretty solid, $170. And that's important because that tells me when you average everything out, gold has been moving to higher ground.
Could you attribute this continuous grind upward to above $2,000 in the last 2 months to anything else besides geopolitical tensions?
Absolutely. One of the prominent things that had moved it was the optimism that the Fed is going to pivot. And then when the Fed came out and announced that they were going to pivot, and they actually listed the rate cuts that they're projecting for 2024, 25, and 26, we're at about, it averages at around 4.6%. Next year, it's at 5 to 5.25. So it's accounting for a 75 point rate reduction this year, but it's also accounting for continued rate reductions to go to a target interest rate, a nominal interest rate between 2.5% and 3 or 3.5%, which is a far cry from where it was elevated above 5%. I think that that is a huge factor that's been highly supportive of gold.
You mentioned in your prompt to ChatGPT that the destabilization of the dollar could be a possible um, impetus for higher gold prices. Is that possible this year?
You know, if you look at the history of BRICS, which is a series of countries that are trying to dethrone the US dollar as its top tier safe currency and currency that is used for global trade, as well as petrodollars. Recently, about a week and a half ago, Russia and Iran signed an agreement in which they said when they sell or trade oil, they will use their local currencies. Now, Russia is one of the more dominant players in there. You've got Brazil, you've got China, you've got other ones, but this has been something they've been trying to do, and I believe without very much success since BRICS began years ago. But it seems as though they might be making some ground. I put that into the prompt because I believe that that's a component that we could see become more elevated than it has in the past.
Now, what do you think the Biden administration is going to prioritize in the following 11 months leading up to the election, when it comes to the economy, at least?
You know what? That is a difficult question to answer because a lot of promises are made right up to an election that aren't fulfilled. He's done a lot of spending, and that's another thing that we haven't even touched on. The national debt's been growing for years, but now we're sitting at, what is it, $44 trillion in national debt. And according to Janet Yellen, Treasury Secretary of the United States, that budget just to service the interest on the debt is equal to the annual military budget. And that is an astounding fact when you think about it. We're spending as much to pay for the interest on the debt as we do to pay for our military. And so that at some point could come and bite America in the tail. We don't know yet because the whole idea of spending what you don't have really started just around World War II. It's a new economic theory that wasn't practiced for hundreds, if not thousands of years prior to that. And so I look at it as an experiment with an unknown outcome. But it certainly is something that is troublesome. And whether or not countries that consistently spend more, a larger component of their GDP, and increase their national debt, what that will result in 5 or 10 years down the road.
Well, we talked about interest rates and the dollar, two of the major components or variables that do impact the gold price. We talked about inflation as well. We haven't talked about the economy. In prior recessions, gold has done quite well. I've actually done the math myself, and every single recession since I believe 1971 that I ran the numbers for, gold has come out either flat or slightly positive over the course of the recession. Now, we know that when equity markets collapse, like in 2008, gold prices tend to fall with stocks, but recover quickly shortly after. Now, are you anticipating an economic downturn this year to the extent that it could impact financial markets? Or are you expecting economic growth to continue? In other words, soft landing, no recession. Which camp are you in?
I am in the latter camp. I'm absolutely surprised, as well as most analysts and economists, that the economy and the labor force and growth has been as little damaged as possible. I believe, which I wouldn't have said a year ago, that a softish landing is possible if we do have a recession from the way it looks because the economy is so robust. I don't see from what we are looking at now that we're going to have an exceedingly hard landing and a deep recession. Now, things could change if inflation ticks up and the Fed then has to pivot back to either keeping rates elevated and things of that nature. But as it stands, the US economy has been resilient. GDP has come down, but they're still looking at an average of around 2%, which is respectable, absolutely respectable. It's slower growth, but it is growth. And when you look in times of recessions, you're not getting positive GDPs, you're getting very flat GDPs. And we haven't seen that yet.
Could you make the statement that gold does not perform well when the economy is just chugging along? In other words, does gold necessarily need some sort of economic downturn or bearish event to go up? Is that necessary?
Well, your point is well taken, and it does have a very large grain of truth to it. Gold does not tend to perform well when there's tremendous growth and US equities are rallying. There used to be a very inverse relationship between equities going up and gold would go down. It was an inverse relationship. However, we've seen exceptions to that rule over time, and that is during periods of quantitative easing. You tend to see US equities go up and gold go up in tandem. But those are the only instances that we have seen historically, an instance where they both move in one direction to the upside, in which we can put some sort of label or explanation as to possibly why. And it tends to be the Federal Reserve having a period of easy money getting easier.
Absolutely. I think a recent example of what you're describing is 2020, of course, right after the pandemic hit, the Fed unleashed unlimited QE, which pushed up all asset classes, including gold and equity. So you're absolutely right there. Now, the Fed hasn't signaled QE. In fact, I don't think they've signaled an end to quantitative tightening just yet, but they are signaling rate cuts. Would rate cuts have a similar, if not the same effect on both stocks and gold, you think?
Well, I think that rate cuts are a form of quantitative easing because tightening is to raise rates. If you maintain the rates, that's at an elevated stance, it's going to have a different effect. But when you start initiating rate cuts, it is very similar to quantitative easing, where you're lowering interest rates and inflation is going back into check. In other words, I think that you can say we are easing when we're cutting rates. Now, we've not done any rate cuts yet. The optimists, market participants, are hoping for March. I myself believe that it could come as soon as the end of Q1 to Q2, more likely somewhere around the second quarter of this year. That's what the Fed doctrine has been. And so if in fact they begin to cut rates, that is a form of easing the monetary policy because they're making borrowing money more available at a lower cost.
I should clarify when I specified easing, I meant in particular the expansion of the Fed balance sheet and thus the expansion of the money supply. And so I'm looking at the Fed balance sheet. It's been going down ever since the middle of 2022 as they embarked on QT, quantitative tightening. And I don't believe they've made any plans, at least not in the public, to re-engage, adding back to their balance sheet. In other words, buying more assets. If you look at this chart, which I'll put on the screen for the audience, the Fed assets, their balance sheet has been somewhat correlated to the gold price, actually. In 2008, spiked up, and so did gold. Throughout 2010s, it grew at a modest pace, but not dramatically. It was relatively flat, and likewise, gold had the same or similar behavior. And of course, we know what happened in 2020. Could you draw the conclusion that changes in the money supply have ultimately changed the gold price?
They have had a dramatic effect, and I think that whenever the components that took gold higher began to be absent in the marketplace, the Federal Reserve has been on a methodical, long-term project to lower their balance sheet. At the top, what was it, at $8 trillion, and they have slowly taken that lower month by month. They're liquidating, I'm not sure the number, but it's like 10 billion or more per month from their balance sheet. They continue to do that. They have made no announcement that that is going to change. And that, of course, would create headwinds that would limit the amount that gold could move to the upside. I believe you're absolutely correct in that assumption.
We started the interview with you stating that inflation is coming down. and perhaps will continue to go down. What assumptions are you making when you say that inflation will continue to go down?
Well, the primary thing is as the Fed raise rates, it's more difficult to borrow money, or not more difficult, but you're paying more for that money. The first consumer thing to really get hit, of course, was mortgages. Mortgages rose to what, about 8% at their high. I think they're down to 7 versus what we had pre-pandemic, which was 2.5 to 3% 30-year fixed mortgages. And that is what we have seen. And that is really what has been important in terms of looking at gold prices itself.
Okay. Now, generally, in regards to your sentiment, how are you feeling about the gold price and the economy? We'll ask you about both the gold price and the economy this year, as we're speaking now, the beginning of January versus exactly 1 year ago, the beginning of January 2023. Let's do a comparison.
I think we're in a different time. If we look at 1 year ago, we were just coming out of a pretty deep recession. It was after the pandemic and the recession that followed, and there was a recovery. We're post recovery now, and we're into a period of what I'll call normalization. In other words, people are anticipating a normalization of interest rates. They're expecting inflation to continue to come down. And the interesting thing about inflation is that when we look at it and we go, okay, it went up 0.1% year over year, and we're going to get that down to 2%. The American public, the public worldwide, is having difficulty with food costs, with just general costs of living. And because inflation stabilizes, that doesn't mean those prices will come down. It simply means they won't go up as much. And I think that that's a very troublesome aspect of the global economy, and specifically the US economy, is that even when inflation gets to a 2% target, the cost of goods are still elevated. They're not, they don't start coming down. They simply sit at this new elevated period. You're not going to see corporations start to reduce prices on goods because inflation is not so much as dramatic as it used to be. And that's something that we want to be aware of also.
You and I never spoke about the gold miners. We talked about the spot price in every episode, but
Mhm.
have you ever done any analysis on the gold miners, whether or not at current levels, which is, the gold miners, interestingly, as you know, are trading at well below their all-time highs, yet the gold price is near, if not has already breached all-time highs this year. So, what's going on there? Is there a disconnect? Is that a good buying opportunity or not so
Okay,
much?
my take on the gold miners stock is a very unique scenario in that every different mine has different costs of getting ore out of the ground, what it takes them to produce one ounce of gold. And because of that, we talk about increased costs in businesses. So there's increased cost, not so much in energy, but in these large pieces of equipment that they buy. All of those things have gone up more than or as much as gold has gone up in a relative basis. And the reason I think the mining stocks are, as they say, undervalued is because once you take into account their cost of mining and their cost of paying their executives and their cost of paying their primary labor force, eats up a lot of that profit. The reason that I have stayed out of doing any kind of analysis of the mining stocks is the necessary components I need to understand in terms of cost of doing business are so complex that it's much easier to just project prices of gold rather than project how much the company is spending to get this out relative to other companies, and how rich a particular vein they're working, what are the costs of getting it out of the ground. That's a complex formula without all of the data available.
Okay, so putting all this together, then can we summarize once more your outlook for gold? ChatGPT was projecting $2,500. What's your projection?
I'm a lot less optimistic. I think in the best case scenario, we will see gold run above 2,200 to 50 to maybe 29 or 22 to about 2,300 as the top band. Also, I'm aware that at any point, for any reason, we can see a deep correction in the market. But I believe if and when that happens, as long as there's still geopolitical tension, as long as the Fed is maintaining their policy of cutting rates, it will find support at some point and then move into the next cycle that will inevitably lead to higher highs than the previous highs that we saw last year.
On the note of cycles, you have a chart here showing long-term cycles of gold going back to 1975. We are currently, according to this chart, in the fifth wave. Am I correct? Walk us
That
through
is
this
correct.
chart. Yeah. What does this
Well,
mean?
yeah, really what the chart looks like is it looks at gold from about $300 per ounce back in about 76 up to 1,000, from 1,000, a 20-year, very long-term correction in the market, which took it back under 1,000. And then from there, it has this huge spike from about 400 all the way up to $1,920, 1,900, which was, if you recall, very, very short-lived. It lasted a couple of days, came down exceedingly hard. But that was the first of a major new time all record high. There it went into a correction, came down to about 1,040. And right now, we're sitting at about 2,080. And the move from 1,050, and that occurred in 2015, is what I'm looking at in terms of a super cycle, the beginning of the fifth wave. And I believe that fifth wave is still in play and has not completed as of yet. And that's why on the long-term view of the market, it really looks at the possibility of gold moving higher from this point.
Now you have this line, the fifth wave line, extending to $2,400, but you said that your top end is $2,300. So I'm guessing you're not using that line as your
No, I
projection.
am, but I'm looking at that. I'm looking at that as 2025 or 26. That's the next target. In other words, when we do these fib extensions, we might start at a 1-to-1 and then a 1.236, a 1.38. And that's how we look at the various years. We also want to take into account how long each of these very, very long rallies and corrections take, because a super cycle is defined as a cycle in which the rallies and corrections are decades in length. And so when we're looking at something from 76 till now, we're looking at a very long-term, almost 50 plus years. And as I said, I believe that it will conclude at some point. It will conclude at a high above the recent highs, because I'm calling that the top of our third wave. And at that point, we'll enter a corrective period. And that will be a multi-year period. And we've lived through that. Because if we look at what happened middle of 2011 when we hit 1,900, it then started trading in a pretty narrow band between 1,800 and 1,567, went back and forth for 3 years until it broke below that. It bottomed out to about 1,020 in 2015, and from there it began to move up again. And so that's what that chart is looking at, those long-term rallies and extended corrections.
Excellent. Well, Gary, thank you very much for your analysis. Happy New Year again. Any New Year's resolutions you can share with us? Do you believe in this?
There's a lot of them. One, I wish, my resolutions are my wish for everyone, that we have a healthy, prosperous, and fulfilling next year. Can't do anything without health. Prosperity is always nice, but that it's fulfilling. When we wake up in the morning, what we do, we gain enjoyment, and that enjoyment helps others.
All right. Very good. Great message for all. Thank you very much, Gary. We'll see you soon.
Thank you so much, David.
Thank you for watching. Don't forget to follow Gary in the links down below and subscribe to this channel.